Hello everyone and welcome to NQ Trading, a complete guide on day trading NQ using order flow reading techniques. My name is Nick Brunelli from scottpulsinitrader.com and I am really excited to be here finally to present you this very effective and profitable methodology to profit from very short-term moves on what can be the most volatile intraday futures product, the Nasdaq futures. Okay, so it's going to be quite a long class. There's going to be a lot of things that we have to go through. So let's move forward and on to the disclaimer. Here at Scott Pulsini Trader, we are not financial advisor or broker dealer. The information provided are for educational purposes only. Trading futures involves high risk of loss and may not be suitable for every investor. Past performance does not guarantee future results. Okay, so guys, keep that in mind all the time. So why trade the NQ? So the NQ is a very thin product, meaning it's not a whole lot of liquidity. Okay, there's enough liquidity to trade and to get filled, plenty of positions, plenty of size, but in general it's very thin, so it moves very fast. But so there's a lot of opportunities even in slow times, in low volatile markets. Okay, so NQ is a product that can trend very well. So if you're a trend trader, you can very often find trades to stay in the trend for very long time, or even for an entire day at times, and so that gives you strong opportunities, for staying in a trend in intraday. But also NQ can swing very aggressively. So even for contrarian traders, you can find a lot of opportunities, to fade moves. There's a lot of rotations going on. So if you like to fade moves, and we're gonna see also how to go into fade those moves, there's a lot of opportunities even for contrarian traders. So it's a very dynamic, it's a very versatile market for all trading styles. And another thing is that NQ likes very much to gravitate and react around certain levels and behaves with patterns that tend to repeat each other. Okay, those levels that are very typical for NQ, we were gonna go into them and discover which levels they are and how to trade them. Okay, and this gives us a little bit of a higher edge compared to some other products, because those levels are usually respected pretty well day in and day out. Okay, so let's start by understanding the most important order flow patterns. Okay, the patterns that we are gonna use and look to get in our entries. So to find those patterns, first of all, you also need to understand how the price moves. So if we want to find high probability trades, we need to understand how and why price moves from one level to another, and how are swings created, what's behind that. Okay, so price is attracted to liquidity. What is liquidity? Liquidity is simply resting orders that are sitting in the limit order book. Okay, from buying and selling orders that are sitting there waiting to be filled, that those form liquidity. Okay, and so strong liquidity levels are levels where there are a lot of resting orders, buyer or seller just waiting there for the price to get there, and the price is usually attracted to that liquidity. Okay, the aggressive participants, they were the ones moving the price, so they will market buy or sell, taking the liquidity that is provided by the passive participants. Okay, so when the predominant side of aggressive participant runs out of steam, most likely the other side will come into play, creating the market swings. Okay, so you'll see. Let's go to the next slide where I say here on Bookmap you'll see visualized the aggressive buyers right here on the volume dots. You see those are market buy orders pushing the price up, and the bigger the volume dots are, the more market orders, the bigger the market orders are in there. So those are the participants moving the price up. So you'll see here there's a strong market buying pushing the price up into the liquidity levels over here. Those are passive sellers that are just putting their sell orders over here at this liquidity, and they are getting filled over here. And as you see, there are not so much volume. The volume is created over here to push the price up, but then over there not so much volume anymore, and start more selling coming in. The buyers here runs out of steam. You see at these tips here of the price, there are not so many buyers as you would see over here. But on the flip side, instead, you'll see more aggressive seller. Okay, putting the price back down. Okay, so this is a really important concept. You'll know that when you have a move up or down, in this case it's up, at some point when you see the buyers running out of steam, most likely there can be a break in the move, or it can go on the other side. The sellers can take over and bring the price back down. It can be short seller, can be taking profit from the previous buyers, can be stops, people that has aggressively bought over here might be stopped out down here, okay, causing more market selling and so on. Okay, but it's important to understand these dynamics, of how buyers and sellers interact to each other and why the price moves up or down, how the swings are created. Okay, so another factor that comes into play then to move price is the intent of trade. So a large book imbalance can skew the auction, causing the best bid ask to move away. So the NQ tends to move a little bit too fast to be able to spot like one tick imbalances. But the thing is, it's more important to understand those dynamics and how participants interact between each other. Okay, so let's take a look at exactly what a book imbalance is. You'll see here, there are sellers hitting the bid, going and taking the price down to these liquidity levels. And as you see here in the book, you see that there are very little sellers over here, only very little orders. And look at this big imbalance there is here. There are 47 contracts waiting here to buy, and below, in the next few levels below, there is overall a very big imbalance between buyers and sellers. So these buyers here are staying in the book. They are showing that they want to buy. Their intent to trade is very strong. They are willing to buy down here, and therefore the seller starts to pull the orders. See, they pull the orders, and so the next best ask comes one tick above. So if you want to buy at market, the next transaction will come at 775 instead of 750, because here is the first seller. Okay, and these sellers are likely to move away and move their orders further up in the book, knowing that lots of buyers are willing to buy down here, knowing that there's a lot of intent to trade and intent to buy around these levels. Okay, so they will, the auction gets skewed, and the best ask is likely going to move away, and as soon as the price goes up, some buyers may want to just jump in and buy at market, lifting the price up. Okay. So let's take a look at like the two most important, in my opinion, patterns, order flow patterns, the absorptions and exhaustion. So the exhaustion is a lack of buying or selling activity from the aggressive player, from the market buy, market sell players. You can easily detect the exhaustions in the microstructure, but doesn't always determine a change in direction in the price. When there is exhaustion from the buyer's activity is often followed by aggressive sellers pushing the price down and vice versa. Okay, we're gonna show some further details, but as most important is, when you see the buyers market buy or market sell running out of steam, there is a lack of activity from those aggressive participants, then the price is likely to go on the other side. Absorptions is pretty much the opposite. It's when all market orders gets absorbed by the resting orders in the book, causing the price often to stop and reverse course. Okay, let's go on and see here some exhaustion example in the microstructure. So you'll see here the price comes down, pushed by the seller around this area over here, and then here you'll see in the microstructure they try to test and see if there is any buyers, but there's no buyers. There's a lack of activity from the market sell orders down here. Okay, this is in the microstructure. You'll see like this small double bottom here, where nobody's really selling. Nobody's really selling. When the price goes up, you hear there's somebody's buying over here, but nobody's selling down here. There's a little bit of selling over here, but not a lot. And even in the price goes up, you'll see here and here, exhaustion on the sell side, and the volume, you'll see it pushing the price up. So you see like a volume imbalance, from the aggressive buyers, but not met by aggressive sellers down here. Okay, here you see the price comes down again, and here it's exhaustion on the sell side. This yellow line is going to be the POC. Okay, which we'll go to look into it later, but you see when the price comes up over here, there's nobody buying here, nobody buying here. Okay, this is exhaustion on the buy side. Okay, when the exhaustion come into play like this, and you'll see we are above the VWAP, below the VWAP, below the POC, and you won't see much. You don't see many aggressive buyers pushing up the price, and on the flip side you see some aggressive sellers down below. Well, you likely can understand that lack of aggressive buyers means also likely a reverse and price taken over by the aggressive sellers, pushing it back down. Okay, let's take a look at absorption. And the absorption instead, it's when aggressive buyers or sellers those orders are completely absorbed by the resting orders. So you see here, price comes down to this level. There's some liquidity resting down here that absorbed the entire sellers, and as a vacuum effect, then the price comes back up. The same down here. Gets down to this level, all the sellers get absorbed, price comes back up. Here all the buyers get absorbed over here. It doesn't even fill this liquidity here at 86.20, and after this absorption, price comes back down, and again absorption over here and absorption over here. Okay, let's move on. So In order to be trading successfully, we need to keep our risk in control. The very first thing, we need to get out of a losing trade extremely soon as possible. And of course, we need to be able to let a profit run. Okay, so by understanding how these price swings are developed with absorption patterns, exhaustions, and booking balances, we can identify high probability entries while keeping a very tight stop loss. Okay, we have seen in the previous slides, those patterns, how those exhaustion and absorption pattern. We'll see how the swings are created. So once we identify those lack of, if we're talking about exhaustions, lack of aggressive buyers or sellers, and likely a change of pace and a swing coming in, then we can find highly profitable trades with a very tight risk. So since NQ likes usually to travel on average 4 to 6 points per swing and can often even run in blocks of 10 points. So we are looking to enter in a trade with a risk at about 1 to 2 points, and our goal, and this is going to be our goal, 1 to 2 points of risk to have an optimal risk reward. And those order flow patterns that we identified, they will meet our criteria. Okay, let's see some example here, some trades that like you see here. Price comes down to a level, gets a little bit, there's some liquidity down here, but gets front run, and there's like a peak of activity, of selling activity down here, and let me go back for a second. There's a peak of selling activity over here, entry at the peak, at the absorption, keeping a 4 ticks, 1 point stop loss down here, and go to look for at least 4 points or more. Get entry here at 0775 and get out at 1175. Okay, that's why those opportunities are what you are looking for. And the same with the exhaustion over here. You'll see price comes down, get absorbed over here, lack of activity from the sellers, entry, we got our level identified, keeping a very tight stop loss. It can happen, that you'll see the volume on the seller recharge and push the price back down again. But if it does, that it will invalidate our pattern. So we are looking for this price to reverse. We know that there's a trend down, and it gets to a point where the chances are that they reverse. And I can accept that it's just a little pause, and then sellers will take over again. But if the sellers will take over again, that's fine. I'll get out with a few ticks, couple of tick loss, 3-4 ticks loss. That's fine. That's okay. But if it doesn't, this is our entry, and looking for the buyers to come and step back in again. Okay. So this is a booking balance entry, and you'll see the price comes down, pushed down by the aggressive sellers, gets into this area of liquidity at 86.25, all the sellers get absorbed by the resting orders here on the bid. Some volume starts to come in right away. One could have been like, okay, take immediately even an entry right here, but price comes down again. There's some exhaustion here on the sell side. There's no selling activity taking place anymore, and you see big buyers sitting on the book and you see here at this level, you know, lots of buyers just waiting for the price to get filled. And when you see this strong booking balance and lack of activity on the sell side to take this liquidity, then you know you can find your long entry over here, keeping a very tight stop loss and looking for the price to move back up. Okay, we're gonna look into video examples and take trades, but it's important to understand and to visualize the dynamics of how it works. Okay, so next up, let's talk about the NQ levels. Where does NQ likes to trade? Okay, where you usually find the liquidity and the levels where to take actions. Okay, so this is gonna be able to add a layer of probability in our favor, because during any trading day, those setups, those patterns that we've just watched, they happen countless times. So it's not like you find like, you know, a couple of absorption and exhaustions. You know, on the microstructure, they can happen really 100 of time, you know, during a trading day. And often, yeah, you see them even opposing each other. You know, you can see like exhaustion on the bid, and then right after that on the ask, and you're like, okay, where should I enter, right? So you don't have to take every single one of them, because if you were to take every single setup, then you might end up to be stopped out way too many times. So we need to have some more probability in our favor by selecting the best trades, you know, in the best places, in the best setups. So since NQ likes to travel and react at around particular levels that repeats over time, by entering the trades using these order flow setups that occur around those levels, we do increase the odds on our favor. Okay, so let's look at those levels. The primary levels are the 50s and the roundies. Okay, the round numbers. The 50s and the round levels tend to be very pivotal areas with strong long-term liquidity that very often just sits there, you know, waiting to be filled for a long time. So you can often find order flow patterns close to those levels that can provide very strong opportunity for complete reversal, for even complete intraday reversal. And you see, like, if the price, for example, is experiencing a run from or a drop, you know, from the previous level above or below, oftentimes it will get close to that level but reverse prior touching it. It will be front run. Okay, so and if the price breaks above or below those levels, very oftentimes you'll see a pullback and retest and gravitate around them, you know, before going to the next one. So what do I mean by that? I mean, like, for example, if you see the price coming from a round number, let's say 8,900 going up to 8,950, it will likely not even reach the 8,950, but find some resistance or be front run a little bit, a few points before the 50s, like between the 46, 47, 48 levels. You're gonna be looking for exhaustions, you know, around those levels, and looking for a price reversal. And the same is true on the other side. If the price drops, for example, from a 50 level all the way down to a round number level, very often you will see, okay, strong liquidity sitting there at the round number, and you'll see the price react before, you know, a few points before reaching that high that round number. So you look for exhaustions entries or absorption entries before, you know, those levels. Okay, so let's see, for example, here this is a very a trade that lasted, you know, almost an entire day, couple trades. You see here at 7750. Look at how strong this liquidity was sitting here. Price comes down, reacts a little bit sooner. I entered here with a long order over here, and then another one over here when the bids were just stacking on top of each other down here at around the 50. It didn't even get exactly to the 50, kind of stopped at around 52 a little bit sooner, then took some profit around here around 62 above the view up, and then the next one took the profit around 7,800. Okay, and you can see like this long-term liquidity here where it sits, you know, from the 50 all the way up to 800, and you see how well it reacts, you know, from those levels. It can happen very often, you know, to see those swings, you know, that can be like an entire 50 point trades on NQ. Even though most of the times my own trading style is more about scalping, you know, 4, 6 or 10 points. You know, sometimes when you have, you know, those trend days when you can let one runner go, you get a good entry and you let one runner go for the rest of the day, and that's when you have some really high edge. Okay, and you here, for example, you'll see the price coming to the 50 and then retest. Here price comes down and you got the 78.50 around this area. Price gets a little absorbed over here, then doesn't really quite trade, just stops a couple ticks before, ramps back up, then there's no liquidity anymore over here, it comes down and then go to retest the 50 and then comes back down again. Okay, and that's what it'll do, that those, you know, those retest of the levels very often, even if it would fall down, let's say to 7,800 and break below 7,800, is very highly likely that it'll gonna come back to the 7,800 before continuing on its path. Okay, so those 50s and round numbers are really important, you know, to find setups and have, you know, look for bigger moves, because sometimes they can be really pivotal for the entire day. You know, those are like the two most important levels. Okay, so the secondary type of levels are the multiple of 20s. So they are often strong levels of support and resistance, and very often strong liquidity levels is sitting there on the 20s, the 40s, the 60s, and the 80s. So between the 20 and 40, oftentimes you'll see the price that tends to range. Oftentimes you'll say you will have a price staying between the 20 and the 40 for quite some hours before breaking either side of them. Okay, and the 40 levels tends very often to be a resistance level, you know, coming from below, from the prices before reaching the 50. So if the price comes down, say from the 20, from the round numbers all the way, then it wants to go up to the 50, the 40 will very often have be a very strong level of resistance, and it will stop or it will pause the price momentarily before reaching the 50. And when pushing above the round numbers, the price will very often reach the 20 before a pause. So if you see a strong momentum higher, breaking above round numbers, the price is very likely to push up and get around the 20, and then find some pause there, come back like around the 10, around the, retest the round numbers, and then likely to go back up again. Okay. And when falling from the round numbers, you'll often see the price very, very often will stop at around 60 before reaching the 50. I don't know. I don't know why, but when you start to know the NQ and how it trades, you'll see those things happening over and over again. You see a big drop, comes down from the round number, goes the way down, and you'll be like, yeah, we're gonna go to the 50 below, but most likely it's gonna get around the 60. There's gonna be some strong liquidity sitting on the 50, on the 60, and it's likely to stop there before reaching the 50 and pull back, comes back up. Let's go to the next one. So you'll see here so you see here on this example those liquidity areas on the 60, on the 50, and on the 80, and how the price travels from one liquidity level to another. And those areas, they are very likely strong support and resistance levels. The price will often be attracted to that level. It will likely go one way or the other. Then we'll see also by analyzing the trend where the price is going. But those liquidity levels on the 20 multiples tend to stop the price for for several points, get up to the 80 and pull back to for about another 10 points, before coming back up. So the price tends to react very well to those 20 multiples levels. Okay. See some more examples. Here we see a long-term liquidity at 40. Price wants to go higher and go meet the liquidity, and you see that more orders are stacking at the 40. As the price approaches to it, you'll see orders stacking on the ask at the 40 levels, and it's very, very likely to provide a very strong resistance level, at least momentary. Come back here, test the 40, come back down to like 40, 35, 33, 34. There's a POC down here, and likely to bounce around this area. Like I said, there's between the 20 and the 40, the price likes to stay in a range, and you see even here, comes down to 22. There's a 20 level down here. In this particular situation, there wasn't a whole lot of liquidity sitting over here, but you see that at the end of the day, this entire day is in a range between the 20 and the 40, even right here. Okay. And this liquidity of 40 is highly likely to provide a little bit of resistance before the next move up to the 50. Okay, so you see here the liquidity at the 20 again sitting down here. You see that all the time. All those are the 20 multiples. You'll see those strong liquidity levels sitting there. Price comes down. There's eating up of the liquidity that's sitting here on the bid, but it's highly likely to continue and come down to find some support around the 20, and likely even bounce around between the 20 and the 40. Okay. And here we see the liquidity sitting on the 80. Okay. In this case, we're seeing some range activity over here, but it's important to see where most often the liquidity, those long-term liquidity are lying. You know, most of the times around the 80, around the 20 multiples. Okay. And here we'll see at the 60, just waiting down here, price coming down from the round numbers above, find some support here around the 70, but the 60 is still waiting down there. If the price was to come down, this is very, very likely to provide a strong support where we can find our entries and come back up. Okay. Here another example at the long-term liquidity sitting at 80. You know, from oftentimes you wanna like front run it a little bit, but it's very likely that the price will come up and test it at some point. But you'll see those patterns and those levels reoccurring every day at every, it doesn't matter, you know, which price it is. You know, the 20 multiples are always very effective and providing really strong support and resistance levels. So look for liquidity sitting there and look for the price to react around those levels. Okay, here again you see the liquidity, long-term liquidity over here sitting at 40. You know, price, you know, staying in the range between the 20 and the 40. Okay. All right. So the action areas. So between the primary and the secondary level, so the primary were the 50s and the round numbers, there are other areas where the price tends to react. There are very small short-term areas, and liquidity is not always seen there. You don't really have to see, like, you know, strong levels of liquidity. Sometimes the price will get there, you don't see any liquidity or very little bit, but the price will likely react, you know, around those areas. And that's where we are going to look for entering, you know, look for our exhaustion or absorption patterns and enter our trades. And those areas are between 5 and 6, or 5 and 06, the 10, the 15 and 18, around, you know, like these small areas. So on the 25 and 26, the 30, 36, 38, 46, 48, 55, 66, 75, 76, 88, 95, 96. Ideally, one could even like draw horizontal lines, you know, on the chart. I just memorize them. I just have them in my head because they tend to be always the same. They don't have to be extremely precise, you know. Like, you know, if I see the price comes down, say for example, you know, from the 20, and you know, I will look, you know, depending on the velocity, depending on, you know, the volatility of the day, but I will look to enter around 18, 17, 16, or even 15, you know, to take my 4 to 6 points profit. And the same, you know, around all those other numbers. Those numbers act as support and resistance. So basically, we are looking to fade moves, okay, to find those exhaustion or absorptions patterns around these levels, okay. That's where we want to get involved, okay. Just so not like any pattern at all, but in particular around those numbers. So if we see like a price experiencing a 10 points move higher, chances are to have a retracement from one of those levels. So if you see, for example, price coming go all the way from 10 up to 20 like in one moves, well, you know, seeing a peak in volume at around 20, signaling also an absorption, you know, that's where, you know, you see that, you know, you got a 10-point move, you got an absorption, you got your level, you're very likely be able to fade that move and look for a retracement, even if it's a small one, you know. But 4 points in NQ can be, you know, do it a few times a day and can be extremely profitable. Okay, let's move on to next slide. So, okay, so let's see some examples here. Here we got a short entry here around the 25. Price was coming up, taking a short. There was some liquidity here at 25.50. I front run this liquidity a little bit when you see this move up and some exhaustion. And price gets some absorption. Sorry, price gets buyers gets exhausted there a little bit. Sellers come in. There's pretty much no buyers even here. No buyers. Pretty much just seller and sellers take some profit. 4 points later, you know, there was a 2-lot position over here. Profit 1, and then second take profit below around this area of liquidity. And you see here, where does it react? Takes this liquidity here at around 18. Was a little bit around 18. One could be taking a long over here after seeing this absorption and peak in volume over here. With I didn't take the long simply because I was counter trading it, and so I took a short here because you see there's some exhaustion over here on the buy side, but there was not enough volume on the ask. So I did take a short only to get stopped out for a few ticks. Price comes up and see some exhaustion here on the buy side. Take another short, see if I can risk this again for a few ticks of risk. I see some volume come in that makes me stay. Then price comes back down again. Here there's some buyers, but it doesn't follow through, and you know, take some profit below down here at around 17 and 15. Okay, price breaks down below. And then now here it keeps going, but you see the biggest thing, the most important thing here to understand is that you can have your losses, and if you see, for example, here there's an exhaustion here on the buy side, you know, you can take a short, but it doesn't necessarily mean it's going to be, you know, it's going to move down. Here I see that there's not a lot of, you know, ideally you want to see sellers taking over, you know, after this exhaustion, and more, you know, red dots increasing and pushes the price down, which it didn't happen. I saw more volume coming, and if it gets below this high, I'm like, okay, I'm out. I'm willing to take this couple of ticks, you know, and see if I can get back in later. That day was a very strong momentum down day, and so I would have rather look for a short trade rather than a long trade. And you know, when you find a good entry, it's easy to get 4 to 6 points, or even 10 or more, you know, in your favor. But you gotta be also disciplined enough to say, all right, if I see the volume coming against me, I'm out. You know, I don't care. You don't need to wait for longer. And even if this trade would have been profitable, you know, I could have easily seen an increased volume and pump the price back up all the way. And you don't want to see that. You don't want to be in a losing trade. You must say, okay, I get out, I take my few ticks, and that's it. Okay, and find another opportunity. Okay. See some more examples. So like in this example over here, the price either we got some strong long-term liquidity sitting over here at the 50, and the price tries to get up. There's some volume over here, but it doesn't get all the way there. Sellers are taking over. Then again, you'll see volume again on the ask, pushing the price up. And again, we have our levels, and we know that likely NQ tends to react before the 50 when coming from below. And so if it comes from below, I will look for an entry anticipating the 50. I will look for a pattern and lack of activity from the buyers that can give me a chance to short it. And so here I got my chance. I saw less and less volume. You see, that compared to the previous move up, to the previous swing, you see this swing. I mean, it's pretty easy to even spot. You see volume on the ask pushing the price up, and then here on this one, there's not a lot. There's the buyers appear to have been losing steam. Took a short over here, after some lack of buyers, that you see over here, and price comes back down from the 46.50 all the way down to 42, 41, 40. And you got the 40 level down here, those 20 multiples level that start to build up depth, and orders here on the book. Okay. All right, so let's move on to the next one. And here again, those levels, price, is being on a range, between the 20 and the 40, and price comes all the way down. We got the liquidity here at 27. So we know that between the 25, 26 area, you can find often, those are the levels that you want to find your entries. You don't want to find your entries like at 29, for example, or 28 or 20. You want to try to see if you can find those entry around those levels, around the 26, 25, 26, around the 18, around the 05, 06, and so on and on. Those ones that I highlighted before. Price comes down, I take the chance to fade this move on a volume peak over here, anticipating anticipating this move to 25, and take some profits at 4 points higher, okay, with the very minimal risk. Okay, so here here I got a couple of stopped out. We got the move higher, price comes back down over here. I enter around the 20. Actually, this was not a very good entry on my side, but saw some more volume coming in, and there was some exhaustion over here, and but then some more sellers took over and stopped me out on this position over here. But as you notice, look at the levels. I was not at a very good levels. I got in around the 22 when this was liquidity, and POC and VWAP were around 18. Okay, so I took another long instead down here, and at 18, price got absorbed over here and took profit one here back at 22, and then back above at 26. And see again the 25, 25, 26 area, how it reacts. One could really easily just even take a short over here and get the price to move back down. But the thing is that the most important is that you can take losses, but you gotta be disciplined also to be like, okay, I was wrong here. There was There was not a good place to enter, but fine, take a couple ticks. Well, there's not a couple ticks. This is 1.5 points, about 1.5 points here. About 6 ticks, 6 to 7 ticks loss, but this, gave me 4 points here plus another. This was almost. This was like 8 points move from here to over there. So it's okay to take losses as long as you get out immediately when you see the volume coming against you and look for the next opportunity. Okay, so next part, are gonna look for trend days or range days. Okay, we're gonna get into that and see how to trade those different setups. All right. So here we're gonna add another layer of probability in our favor. So up to now we understand how price moves. We understand what moves the price and the dynamics between the market participants, and we understand in particular how NQ moves around certain levels. We've seen the primary and secondary levels and the action levels. So is that enough, to be able to have our playbook? It can be already enough, but let's get into some other details. Getting into trades when the price is trending or in a range will add another layer of probability in our favor. So in this case, trend lines will help define high probability and low risk entries during range expansion times, during trend days. And volume profile will also help us finding high probability and low risk entries during range compression times. So let's see here, for example, I see a strong trend day up. I got my trend line that's over here, and we're looking for absorption on exhaustions at the trend lines. You got at the trend lines, and in particular, if we find them, the trends end at those NQ action levels. And one would be like, how do you even draw a trend line? Because it's easy to say, oh well, you got a trend line already designed when you're here, but no, that you want to draw a trend line at the very beginning. Like if you have a downtrend, and you see the price breaking above the previous trend line, then I don't have it on this screenshot in particular, but you're gonna start looking already for the very first higher low. Price comes back down, experience a higher low, bam, go to your trend line and draw it and make it go all the way, because on that very first higher low you might already be able to take a trade if it's one of these NQ levels, or you might look for the next break trend line touch. And you see here a huge difference. You see look how many buyers are here, and there's a boatload of buyers over here, and there's nobody selling. Price stays above the VWAP here in the day, some exhaustion over here, and price goes up again. Boatload of buyers, not much sellers. Exhaustion, boatload of buyers, not much sellers. Boatload of buyers. Yes, here's some more selling over here, a little bit more, but look for entries around that trend line possibly. Also, because if you see a break of the trend line with volume, you want to see volume pushing the price down, then you don't want to be long anymore. So again, this is pretty much what I'm talking about. Look, you know, NQ will do that very, very much, you know. Day in and day out, you'll see, you know, big V reversals where you get like a trend down, momentary trend down, you know, and you can look for exhaustion. Here there was an exhaustion entry at the 18 level, which coincide with a trend line that was coming down. Take some profits here. Then what happens? They get a trend line break. You look for that. You know that, you know, price goes from a trend down to the trend up and vice versa. So you know that whenever you have a trend down, look for a break of the trend. Look for a break and see if there's the momentum kicks in and you can find, you know, another long setup up. And ideally, I could have entered long over here, which I didn't. I took this long instead because I was waited for more confirmation at that time. But it doesn't matter, you know, we are not here to find the tops and bottoms. We are not here to take every single trade. We don't look for that. Okay, we don't want to overtrade. We want to find highly you know, highly probable trades. Okay, so here you got a break of the trend line, and you see that there's no selling activity here, just buyers, and you know that once you get this, you'll be like, okay, let's look to find the next trend up. So as soon as this break, look for a higher low, you know, and start drawing a trend line over there. I do that all the time, you know, and getting long. Ideally, I should have got long already right here because there was no selling. The break was already in place, you know, and I could have got long already there. But in this particular case, I got long instead over here. Okay. Probably there was not, I can't see the numbers on the screenshot in particular, but probably this was not around one of my preferred levels. Okay. Ideally, one could also say get long at the momentum, you know, like you see the volume come up, you see the break, and enter long at the break. I am not a big fan of that because my risk will be higher, and my risk will be somewhere down here, you know, below the volume cluster. I have to give this room in order to have the trade to play on my favor. But I don't. Ideally, I always liked to fade moves instead of enter with market orders or with, you know, or with stop orders, in, you know, joining in the volume. Okay, because again, if I would enter here, my risk would be below this volume cluster, and so I'm not comfortable with that. Okay. So here, this is something that you see extremely often. And Q likes to trend very much, but you know, you see the buyers sweep up and takes this liquidity, and you're gonna look at the volume profile over here. You know, you'll find that the price is gonna tend to stop and create this balanced volume profile and acceptance around this area. Okay, and you want to look for long entries, you know, at the low volume nodes, you know, when there's a lack of volume around here. That's where you want to look for long entries. And oftentimes you will see even a little bit of dips below, which I like to call them cookie dips. A cookie dip for me is like when you see like a dip that comes below down here, bump comes all the way back up, and most of the times it's just gonna continue going. It's gonna trap sellers, you know, make him think that it's gonna go back down, and instead it's just gonna go all the way back up and break above That also happens all the time, but look for this type of movement. This, even though this is a very small type of range, you know, from 62 until 66, it can be a very small type of range, but this this range is volume profile range. It can be, you know, even it can last an entire day. Okay, like on this year, for example, we have a little bit of a wider range, and you got a balanced volume profile and the low volume node over here and over here. That will you know, we're gonna look for fading those moves into these low volume nodes. Okay, so we're gonna look for our levels where they are. Here we got the 50, we got our 45, 46 level around here. We got 45, 46 area. You got the VWAP down here, and this balanced volume profile. So we know that we're going to look for entries around this low volume node, possibly above the VWAP, a little bit into this liquidity that's forming over here, and the NQ action level, you know, around 45s and 46. Okay, and when you take this trade, look to get back into the volume profile POC and above into the higher low volume node above. Okay, so let's get into some additional order flow patterns: spoofing, layering, book flippings, and icebergs. Okay, so a spoof order is an attempt to skew the auction by placing a large limit order on the book, but with no real intention of being executed. So usually spoofs appear just randomly in the limit order book during the course of the day for a very short time. They usually will try to move the price in a certain direction, and our job, we're gonna try to look for a moves towards the spoof, so counter trade. Okay, look to get look for trades into the spoof. So most of the times though, it's not a setup that I would highly recommend, because it has lower odds of playing in our favor. Because whenever we see a spoof, it doesn't necessarily mean that we can, you know, take an order, enter the market and trade against it, because oftentimes it can just move, you know, those spoofs can move the price all the way, and so there's less probability, you know. So it's important to understand and recognize those spoofs and the effect that they can have on the market, and look at the broad market, you know, what's happening throughout the day and what are those spoofs doing and their intent. But there will be little action, you know, from my side, from our side, and we'll unlikely take a trade to counter trend the spoofs. Okay, but let's take a look a little bit at how it works. So you'll see here, when you see those random big orders just coming, those are very likely spoof all the time, spoof orders that have no intent of being executed. You'll see, and you see the price here, they try to skew the auction in favor of the sellers and try to move the price back down. You know, the price follows back down, and if the price would happen to come up, they will take it off because they have no intention of being executed, but still again trying to push it down and all the way down here. Okay, and then what happens next? This is the same day, just a different view a little bit later. Same day, just a little bit view a little bit of different view just later in the day. Move down, they accumulate lower down here, goes to meet those buy orders, and then price comes all the way back up. They take the spoof orders, they take them off, and they are free to take these buyers up. But so why do the spoof orders are there? So this is important to understand, because most of the times, think about it, if you are a large player and you wanna buy, and you wanna try to buy lower, you don't wanna, you can't just, if you were to place a large buy, you will probably screw the auction on the other side, and maybe you will end up not even getting filled. Let's say you just put a buy order down here without any spoofs. Somebody may just like front run you and have the price move up. So with you might likely not even get filled. But if you place some of those spoofs, you have the chance to scare the market away from those spoofs and move them back to your favor, get filled. You can get partially filled with the limit orders and partly put some market buy orders, a little bit, then let the rest go. Okay, so they can happen all the time. Many times it also happens that when you see some of those market orders, you can just counter trade them. For example, you see a market sell order, you can buy and look for the market to go against it. But it's just like low probability. So because sometimes they will be able to move the price down, and so I don't recommend doing it. I personally don't do it quite as much. It doesn't give me a much bigger edge than what you already have by trading the trend with the exhaustions and absorption patterns. But it's good to understand how the market does, why it does that. If you see the price moves down and it's driven down by spoof orders, you will know that chances are that somebody wants to actually buy lower. And so just be careful and read what's going on, and so that you can buy also a little bit lower, or wait for the trend to reverse. Okay, you see the volume coming over here, you see the sellers coming back down but not being able to break below and creating a higher low, and then again volume pushing the price back up again. So try to look at that more than what the spoof does. Okay. And then you see another example here. There's a price goes over here, and as soon as the spoof order appears, price sells off, come around this area. There's some buying that's accumulating down here. They want to buy, and then as soon as the price move up, the spoof gets pulled. The spoof does not get executed whatsoever. The intention of this order was simply to scare the market down, and so that somebody could just accumulate down here. Okay. So layering is usually another form of spoofing, but simply done on a multiple level. It is hard to say if it has manipulative reasons, because sometimes market participants also distribute order on multiple levels with real intention of being executed by having priority in the queue. Okay, so when appearing at the high or low of the day, it can likely mean reversals. So when you see strong layering on the books, then look for exhaustions on the other side, and see if the price can reverse. Okay, so for example, you see here there's multiple layering up above, and for 60, 70, and around 80 over there, strong level of liquidity, and here another layering down here. Like I said, price is often attracted to liquidity, yes, but when you see something like this, that those are highly likely intentional orders that are sitting there, that are trying to actually get filled. And so here I took a short, here the price broke down below the 50, came back down and went back up, retesting around the 50 area. There's a lot of layering above, a lot of liquidity. There's no liquidity below, so that gives me a probability to look for a short-term downtrend, and see the same trade played out very well down here and went all the way down to the POC and the VWAP. Okay, from the 50 all the way down to the 23 area. Okay. So the book flipping you will often see it during trend days. So there are limit orders that are getting pulled on one side and added to the other side, and those will fuel the price momentum. Okay, orders can be pulled and added, or executed and immediately added on the other side of the book. Sometimes it's hard to detect as they are getting pulled right before the price gets there, like at the very last instant. So it's hard to say if they are actually getting executed or not. You're gonna have to zoom in and go to see into the microstructure if they are actually getting executed. But it doesn't really it doesn't really matter. What matters is the overall intention of the market. You see, big orders are easier to spot and more reliable as confirmation of momentum. So you'll see here, as the price moves up, those sellers are pulling the orders. These ones they get pulled at the very last second. Here they get pulled a little bit before, and what do? They add below. Okay, they pull those orders down here and add below down here. So they flip their orders on the book. That's why it's called the book flipping. Okay, those will when you see something like this, what does it mean? What it effectively means is that those sellers, they don't want to sell anymore. They place those orders there to sell, but they change their mind as the price come back up, and they change completely side, and they decide they want to be buyers instead of sellers. Okay, and you see it over here. Another example. Price comes down, those orders, those buy orders get filled, and but you see they sell more. Those are highly likely the same ones who bought over here. They decide to sell over here, and they actually sell for more contracts that they bought over here. So they completely are flipping side. Okay, even though I don't have the entire book over here, you can see by the coloring, that they might be, for example, buying 20 over here and selling 30 down here, for example. So they decided to change their stance, and be sellers instead of buyers. Okay, this could have been, they could have easily just took profits on a short trade, or they were trying to get long as well. But the most important thing to see is that this book flip gave an opportunity to short and look for the momentum downtrend. Okay. Iceberg orders. So the order book only shows a small portion of the full order. That's an iceberg order is basically it shows only a portion of the entire order, and the rest it's just hidden in the book. Okay. Once that small portion of the order gets filled, immediately the remaining part or the order gets submitted. So it's often used by big players to hide their bigger size from the book so that they don't skew the auction. This iceberg order can be used to determine big players' intentions in some markets. However, in my opinion, it provides little to no use on NQ. You'll be like, why do you show it? Because it's more for a matter of understanding the market, but effectively I don't really use market or iceberg orders to take any trade decisions. You'll see some on Bookmap you can have them displayed, and here there's a the Bookmap detects automatically when iceberg orders are set in place. Those are iceberg order to sell, 10 contracts, for example. Here you can be, one contract short, and when it got filled, 10 others got submitted, and so on. But at the end of the day, I don't, you try to make it simple, for NQ, in my opinion, it's not something that provides any use. Okay, there might be some people who look into those, but not me, not the way I like to use it. I try to look for a little bit of higher edge with iceberg orders, but I couldn't really find any, and so it's just good to understand, why they happen, but there's not going to be a lot of use. Okay, so before we go into some video exercises and look for some trades in some videos, let's recap a little bit and put all together. So in the early stage, in the beginning, like if you are learning out this strategy, it's probably best to avoid the very first half an hour of the day, because it will likely be too fast. There are really a lot of opportunities during the day, and so you don't need to get involved when the market is still too volatile and undecided. Okay, so when you are still learning, just stay away. And in the first half an hour, just take your time and look what's developing. Let the price spike up and down for the first few minutes, and then look for those opportunities later on. Okay. Look what's happening after the first half an hour. Do you see a range taking place, or is it trending? Sometimes, if you have a very strong trend day, it will likely start right off the bat. Sometimes the price will just spike right up out of the gate and start a trend day immediately. And if you wait the first half an hour, you're likely going to miss part of the trade. But it's not a big deal, especially if you're in the beginning. You're going to have to practice a lot, and especially in the beginning, even if you miss out on the first half an hour big move, there are still so many opportunities during the day. The price can place a big move up, and then it can stay in a range. Look at the VWAP, and the volume profile, what it is, and look to target the POC or the VWAP, from those from looking at the volume profile, for example. Okay, and if you find a trend day, look for reversal patterns on the trend line and the NQ levels, as well as consolidation range patterns on the volume profile. Okay, So those are the main objective, look for trends by looking at trend lines, and look at ranges by looking at the volume profile, okay, together of course with the MQ levels that I outlined a little bit ago, okay, in the earlier part. So some other details to remember is always get out immediately if the volume on the other side comes in, because when you least expect it, a reversal can come against you and never even come back. So a 6 to 10 tick stop is enough if the entry was good. So if you find an exhaustion, on the direction of the trend, and you get involved, you get long, keep that risk tight and be disciplined. Be able to say like, okay, just get out if you find the volume, coming in on the other side, because if you don't, next thing you know, the volume gonna kick in on the other side and reverse the entire day, and you're gonna be sitting on a hugely losing trade. So just get out, take that little bit of loss, move on, look for the next pattern. Okay. If your entry was good, if you get in at a good NQ level, if there was a trend line and all that, you're gonna have very high chances that the price is gonna come towards you. So even if for that one, even if that one particular trade would have been a losing one, the next one, if you follow those rules, will be highly likely a profitable one. Okay. Another thing is consider being done after 30 minutes of trading, because we tend to lose focus and discipline after some time, and not being able to take good decisions. Let's say you start trading and you trade for half an hour, and then you got, in the very beginning, the very first few trades, you're going to be very disciplined. You're going to be like, okay, very focused. You're going to get out if the price comes against you. You're going to take your profits. Everything's good. But after a little bit of while, you may lose that discipline. You need to be aware of that. You need to know that you may get tired. You may not be focused enough. Okay. So if you had a couple of nice profitable trades, just consider be done. You don't have to pick top and bottoms. You don't have to take every single setup throughout the entire day. All you have to do is really try to make 10 points. All you have to do is really make 10 points a day, and that will be enough. And with those setups, you will very, very likely reach way more than 10 points, very likely be like even on the 20, 30 points, easy to make in a day. But do not be greedy. Do not search for all the time, every single setups and everything. Just get done, get out, go to the gym, go take a walk, refresh your mind, and consider be done after half an hour. Another thing is, do not listen to noise from outside sources. The relationship between buyers and sellers in that exact moment is all you need to focus on. So do not listen to news or opinions on this from this or that other trader. Don't have bias. Don't be like, well, I think the market is going to go up today because I heard that, Amazon had earnings, or because that guy said that everything is well, or because of this or that, or because Trump, or because whatever. Do not listen to anything that's outside. Just look at in that exact moment. These are very short-term scalps, you know, they can last even 5 seconds to a few minutes. So that's what you need to look for. That's all. Just you and the relationship between market price and the between sellers and buyers. That's all you need to focus on. Try to clean your mind, you know, from what you think is going to happen. Just try to just clean out everything, okay? Do not expect anything from the market, okay? No expectations. Just like I said a minute ago, no bias. Just look for those high probability setups with that risk. Wait, you know, don't be in a hurry. Don't chase trends. Don't chase setups. Let the setup come to you, okay? You need to have the patience to just sit there and wait for the price to develop and develop those patterns, because they develop every day and you do not need to chase them. You just have to wait for them to appear in front of your eyes, you know, just like I've explained, and make sure you practice a lot. Okay, so we're gonna go into some live exercises now, and you know, make sure you review this entire video and read it over and over, and keep those slides in place and practice first on simulation mode and then on live, just after you have fully understood and you have your routine done. Okay, all right, let's go into the exercises.